Today I'm going to talk about a opportunity that exists in iron ore, particularly Cleveland Cliffs, an American iron ore company. You can see I have some of the financials up. The iron ore price historically, this is the historic price. You can see it was a spike 2011, increase in iron ore prices in 2009. They flatlined, they dipped, and then went back up. These are iron ore prices, and this is per ton. The opportunity that exists now, you can see as of lately, iron ore prices were low in 2018, around 65, and companies were still profitable at that level. However, end of 2018, beginning of 2019, there was a huge spike. Iron ore prices went from about $65 to currently $120. So there's been a double in the price per ton for iron ore, which, you know, if the costs are the same, but the price you can sell the product double, I mean, you're standing to make significant money. Let's say you're selling bricks and it costs you 25 cents to make one brick, you know, concrete brick, and you were previously selling them for 50 cents, and now that price, you know, you were making 25 cents per brick. Now that price doubled. 25 cents is your cost. Now you're able to sell that brick for $1. So, you know, your profit margin increased drastically. So this is the company. This is what year is this? I think this is 2000. We don't even need 2013. We can just look at, we don't even need this either. We can just look at, this is their most recent quarterly results. You can see their current year. The analysts, people that cover this, you know, number of analysts that cover the company pretty low, which, you know, may present an opportunity there. But the estimate, you know, this is the upcoming quarter. Oh no, this is the previous quarter. This is the estimate for the current year. You're looking at an average estimate of $1.80. The high is $2.25. Year ago, $3.71. And for the current quarter, we're looking at 57 cents. You know, it's compared to 55 cents last year. This is the issue. The price skyrocketed mainly because, where are we? Mainly because there was there was a dam disaster in Brazil. The Vale mine, which is probably one of the top 3 biggest in the world, it collapsed. This industry, because the prices were low, the companies weren't able to maintain their dams as they once were because the prices were too low. So, you know, costs and profits were spread thin. So companies had to cut costs, and they cut costs in maintenance and monitoring. And as a result of this dam collapse, Vale, they cut back on iron ore production throughout all of their dams or all of their facilities. And, you know, they increased their maintenance and monitoring, but they pretty much slowed down the process. So this delivered a shock around the industry last year, which caused prices to double, on top of China tightening up their pollution standards on some of their mines. So, you know, it's been a string of good luck for Cleveland Cliffs. And here I have, you can see, let me just go to the price. You can see, here's the price. I mean, the iron ore prices are pretty low. Then you got a skyrocket in prices. It's a dollar collapse, which, you know, we're upon a dollar collapse now. Then you got the subsequent increase in the stock because the dollar collapse, which caused iron ore prices to increase. So we're on top of a dollar collapse, which hasn't happened yet. It's been, you know, planned to happen as the Fed will cut rates. You know, they're pretty much certain to cut rates on top of a limited supply or a, you know, mass problem. So we could be looking at historic iron ore prices, and you can see the stock, you know, as it shot up from, you know, you're looking at $1, $2, went to 106, you know, 50 times your money. then $2 back to, let's say, 100. Dividends were, high in this period. You can see the dividends here. Dividends, you're looking at, if you got it for $2, even $5, let's say, this is a 10% dividend. You got it for $5, that's a 50%. What's that? Maybe 12. So, and of course, the dollar appreciated here, so iron ore prices decreased over that period. So it presents an opportunity. The only other thing we have to look at is the price per ton and the volume. So here we can see, this is in 2011. This is when they had a good year. You can see the company's maintaining revenue per ton expectation of 140 to 145. And the sales volume in 2011 was 29 million tons. It was an expected price of 20 expected volume of 28 million tons. And we can compare that to their latest 2019 first quarter. So this is their cost of goods sold. They're looking at in the $60 range. And the outlook, let me just find the sales volume. Do I have it here? Yeah, here's the sales volume. So instead of the 28 million as in 2011, they're looking at 20 million. And this may increase, as I mentioned, due to the Brazil dam collapse, which affected their mines. And then we can look at the, this is the volume. And the price per ton, you saw here it was 145. Where's the price per ton? Right now we're at 120, and usually their price per ton, because this is, I think, the spot. So usually their price per ton is about $10 higher. So they're looking at 130. So you're looking at conditions that were present in 2011 when you had a $100 a stock price. Stock price is $10. In 2011, 2010, 12, you were looking at earnings per share $7. Here it is right here. 2011 hit $11 per share. And this is conditions with a similar price per ton and a similar volume. But it doesn't account for the dollar collapse. If the dollar collapses, you're looking at a doubling maybe of the price per ton. So from maybe 120 to maybe 240, 200. And, even if with the current conditions, if you're looking at earnings per share of 5, half of this number, even though the volume isn't half, and even though the price per ton isn't half, let's say we looked at half or even about $8. Stock price right now is $10. The dividends would increase. I mean, this stock would move fast. The next earnings are in July. So these earnings, 3 months prior, what's this month? June, July. So you're looking at maybe May, so it's going to account for, April. So it's going to account for, iron ore prices from the $90 to $120, and this may go up. So this quarter should be an excellent quarter. And if this momentum continues, you could be looking at it back at $100 stock price, and they increase buybacks. So the shares outstanding, let me look at the shares outstanding. I actually haven't looked at it. I know they had to issue some possibly during the last crisis or downturn in the industry. So they said 120. Well, 2011 was 140, so it was half. So you can maybe expect a half earnings per share price based on that, even though the earnings per share price is 370, because they got rid of some other functions such as coal, and they got rid of a lot of bad debt. So the price may actually still be able to hit the $5, maybe $6 range, and they've been buying back shares. So I don't know if this, let me see if I can find the shares outstanding. Oh yeah, so it went from 304 to 282. So they're almost, they're going back down, maybe 250 this upcoming quarter, may get back to 200 maybe this year, next year, probably next year. So it's looking to be a good setup for the iron ore industry, in particular Cleveland Cliffs Iron Ore Company. So we'll continue to see what happens. It's June, I think June 22nd right now. So we'll continue to see what happens. Stock price is at $10, but I think based on the economics that I showed you, you know, you could do your own research that it presents a good opportunity. On top of, you get a 2% dividend, which if the earnings per share increases to $6, $7, $8, I mean, they can easily increase this to $2, as was seen. Where's the dividend? As was seen in 2012 from the results 2011, and 10. You know, you're looking at 20% possibly dividend. But I think it's a perfect situation. It's a perfect storm for iron ore companies, and in particular Cleveland Cliffs. Let me know in the comments what you. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.